In 2010, Tesla was a small cap stock, but by 2020, it had surged more than 10,000%. And last year, Nvidia, already a mega cap, ran nearly 240% in just 12 months. So here's the question. In this market, do you go with the mega caps that can grind through the inflation, or small caps that could rip much higher on rate cuts? For me, the answer is simple. You don't just pick blindly, you build what I happen to call a barbell strategy. Right now, markets are betting on rate cuts. Futures imply that the Fed will ease policy soon, but inflation, it's not gone. Core CPI is still running around 3.1%, well above the Fed's 2% target. And tariffs are just part of the drag. Research shows that the tariffs could add half a point to nearly a full percentage point to the inflation that's already passed through. Yale's Budget Lab says that tariffs are already pushing core goods almost 2% above trend.
Worst day ever.
That's the sticky side of our economy. And that's where mega caps with pricing power and fortress balance sheets can grind through the pressure. But if inflation eases back, well, that's when small caps react first. You see, they carry more floating rate debt. A rate cut would slash their overhead costs immediately, and that happens to flow straight into its earnings. And if tariffs get struck down in court, that's effectively another rate cut, especially for small domestic companies. And of course, we'll find out soon enough because the Fed gives its next update next week. The bottom line, we're not just picking one outcome. I'm going to build a barbell where I'm going to anchor on mega caps on one side and adding torque with small caps. But before we unpack all this, if you get any value from my videos, please consider pressing the like button so my content can continue to grow. Let's start off with Nvidia. They dominate the GPU market for data centers with 94% share. That dominance isn't a one-off cycle. Each generation of AI requires more compute than the last. Meta reportedly bought over 350,000 Nvidia H100 GPUs to train its latest Llama model. Then on the other hand, consider robotics. Amazon already has over 1 million robots in its warehouses today. But those machines are simple. They move shelves and they scan barcodes. But Nvidia wants to power the next generation. Robots that see, navigate, and they make decisions on the edge. Its Jetson platform is designed as the brain for drones, autonomous vehicles, and factory systems. The robotics market is forecast to grow more than 20% annually for the next decade, compounding into $1 trillion industry just on its own. Nvidia's play is to be the compute layer for every one of those machines. Then, of course, there's networking. Last quarter, Nvidia posted $7.3 billion in networking revenue, nearly double what it had a year ago. That makes it the fastest growing part of their business. And where does it go next? As AI clusters to scale into tens of thousands of GPUs, networking spend rises faster than the GPU spend itself. The bottleneck then shifts from raw compute to how efficiently those chips can move data. And that's why hyperscalers like Amazon and Google are already testing Nvidia's new Spectrum X Ethernet fabric, designed to extend its dominance well beyond InfiniBand. If Ethernet adoption takes hold, Nvidia isn't just selling GPUs. It's standardizing the entire AI data center stack, from chips to cables to the interconnect. The next company is Credo, which makes the high-speed connections inside AI data centers. Their parts are already showing up at Amazon, Microsoft, and xAI, each now contributing more than 10% of total revenue. The growth happens to be staggering. Last quarter, revenue jumped 274% year over year to $223 million, blowing way past expectations. Management raised full-year guidance to 120% growth, up from 80%, while margins held around 65%. And that happens to be rare for a small cap supplier. But this isn't a one-product story. On some platforms, Credo's connections are now in over half of the server ports, and attach rates are climbing as clusters move from 800 gigabit towards 1.6 terabit Ethernet. Analysts estimate that the total market for Credo's core IP is 15 times larger than its current cable revenue run rate. Then, of course, optics are just another lever for them. Credo expects its optical chip business to double by fiscal 26, positioning it for the next generation of AI fabrics. And unlike many peers, the balance sheet is clean, nearly $300 million in cash and no debt. That gives them a lot of room to keep scaling as hyperscalers lock in on new standards. Speaking of companies that wire things together for growth, let's talk about how you can earn even more from your credit card points. What if those 20,000 points, typically worth $200, were now worth over $550? That's 176% growth, which is what the average Bitcoin rewards have appreciated when earned and held for 1 year on the Bitcoin credit card. That's the difference with today's sponsor, Gemini. Instead of earning depreciating points, their credit card turns everyday purchases into an investment into Bitcoin or your choice of over 50 other cryptos, all with no annual fee. The Gemini card is also a MasterCard Elite, so you get the premium benefits that are universal, being an elite status. So when you happen to buy those everyday purchases like lunch, gas, or even your weekly groceries, you'll now be getting a percentage back that's invested for you. And for those of you that read my free newsletter, you know that I treat crypto as a small high-growth torque allocation within my portfolio. And this card automates that strategy from your everyday spending. So instead of points losing value, your rewards have real potential upside. And as an added incentive, if you sign up at gemini.com/Brian, you'll get $200 in Bitcoin when you spend $3,000 in your first 90 days. The next company happens to be Amazon, where AWS holds about 31% of the global cloud market, nearly more than Microsoft and Google combined. That dominance makes it very sticky because Amazon isn't just selling cloud storage. It's embedding AI into its stack. Bedrock lets enterprises deploy models directly on AWS. Q pushes generative AI into its workflows, and the in-house chips, Trainium and Inferentia, cut costs while locking in its customers in a little bit deeper. But the real surprise is their advertising. Amazon now generates over $55 billion a year just in ad revenue. That's only about 8% of their total sales, yet it drives more than 25% of its entire operating profit. It's also growing faster than Google's core search ads. And the edge is simple. Intent. More than half of US consumers start their product searches on Amazon, not Google. When people are ready to buy, Amazon is where they go first, and the ad dollars, well, they follow. I mean, think about it. How often have you found yourself in a store and suddenly you go on Amazon to see if this is a good price? And of course, you want to see what kind of a rating it had too. I know I'm guilty of it. And in the background, Amazon is building Project Kuiper, a constellation that will exceed 3,000 satellites by the end of the decade. Early test runs have already hit 1 gigabit per second speeds, and contracts happen to be in place with government sites as well as rural states like Wyoming. And recently, they also mentioned that they have a contract with JetBlue. If Kuiper scales on schedule, it becomes the silent winner. Global broadband that extends AWS to every corner of the map. Our next company is Mastech, which builds the infrastructure that makes AI possible. Power lines, substations, and fiber networks. AI clusters don't run without electricity, and policy is forcing investment. The Federal Energy Regulatory Commission's Order 1920 requires new high-voltage transmission projects to connect renewable energy up to the grid. Mastech is one of the prime contractors positioned to execute those builds. So backlog tells the story. Mastech now has a record $16.5 billion of work booked. These are not speculative bids. These are contracted projects. Transmission builds are projected to grow nearly 10% annually through the decade. And fiber is the other lever for them. As data centers multiply, Mastech's communications division is laying the ground level fiber to connect them together. The federal government's $42 billion broadband equity, access, and deployment program is starting to roll out, and Mastech is already in line for those awards. This happens to be that torque side of the barbell, and unlike megacaps, Mastech's fortunes swing with policy and rates. But today, both are tailwinds. The mandates are in place, the money is earmarked, and the backlog is growing. The next company is Arista, which supplies the high-performance networking gear that ties AI data centers together. Of course, Nvidia may dominate GPUs, but hyperscalers want open Ethernet fabrics. And of course, that's where Arista is winning. The company's switches and its operating system, EOS, give cloud providers flexibility to scale clusters without being locked into a closed ecosystem. Look, AI is already pulling demand forward. Arista guided that more than 30% of its 2025 revenue will come directly from AI networking. Looking back into Q2, revenue grew 25% year over year, which is way outpacing its peers, and it's grabbing share in the cloud data center. On top of that, gross margins consistently hold above 60%, proof that customers pay for performance. And here's here's the upgrade cycle. Data center networking speeds are doubling. They're moving from 800 gigabits to 1.6 terabits per second, which I mentioned earlier. Every new generation of GPUs pumps out more data, and without faster switches, the whole cluster slows to a crawl. And that's where Arista comes in, because they're positioned to supply both the hardware and the software that keeps those pipes running at full speed. Without a doubt, Arista isn't the biggest name in AI, but it's becoming indispensable. The next company is SiTime. Not sure if I'm pronouncing it right, but hey, we're going to go with it, which makes the timing chips that keep data flowing inside the AI systems. Every GPU, switch, and server depends on precision timing. If those signals drift just even the slightest bit, then the network slows or it fails altogether. That edge is becoming critical as networks scale from that 800 gigabits to 1.6 terabits. Growth is showing up in its numbers. In its most recent quarter, SiTime's revenue climbed more than 40% year over year. And of course, that was led by the hyperscalers like Amazon and Google and networking demand. Unlike commodity chip suppliers, SiTime runs an asset-light model. Gross margins are holding above 60%, and the company carries no debt, giving it leverage as AI adoption forces tighter timing standards. Like a few of the others, this is not a household name, but it's becoming indispensable. You can add GPUs and fiber all day long, but without stable timing, none of it runs. This next company is ASML, which makes the lithography machines every advanced semiconductor depends on. It's true that ASML has held the EUV monopoly for years. So why is it interesting right now? The answer is new technology and new demand. The next node in chipmaking requires high NA EUV. And in plain English, that just means that a new lens system that makes the light beam a little bit sharper, kind of like going from 1080p on your TV to 4K. Because standard EUV can etch features down to about 3 nanometers. High NA takes that even smaller toward 2 nanometers and below. That unlocks faster, more efficient chips. And every advanced fab, well, they're going to need an upgrade. Each high NA system sells for a little bit more than $300 million. And fabs from Intel to TSMC have already been placing their orders. Shipments ramp through 2025 and 2026, which is really setting up for a completely new upgrade cycle. So while ASML has been essential for years, high NA plus AI and robotics adoption makes this the start of another growth leg, not the end of one. So how do we pull this all together? This market doesn't reward guessing. If inflation stays sticky, mega caps like Nvidia, Amazon, Arista, and ASML, they keep compounding on fortress balance sheets and their deep moats. But if inflation cools and the rate cuts flow through, torque names like Credo, Mastech, and SiTime, they're going to deliver leverage on massive upside. And of course, that's the essence of the whole barbell. One side is going to be anchored in premium giants. The other side is balanced with a little bit of those small cap torque. And that wraps up my overall list for today. As always, thanks so much for watching.